The money in your bank account doesn't really exist. That's not a metaphor, and it's not conspiracy talk. If every single customer walked into their bank tomorrow to withdraw their cash, the system would collapse within hours because the money simply isn't there. This isn't an accident or a glitch. It's the design of the global financial system, a trick so old, so entrenched that we've come to accept it as normal. It's called fractional banking, and it is the quiet engine behind global debt, inflation, and the illusion of wealth. Once you see how it works, you'll realize that money itself is built on promises that can never truly be kept. To understand how this began, we have to go back to a time before our world ran on digits in an app. In medieval Europe, gold and silver were money. If you were wealthy, you had coins in a chest or jewels you could trade. But carrying bags of gold was dangerous, so people began leaving their valuables with goldsmiths, men who had secure vaults. In exchange, the goldsmith would issue a receipt, a simple note promising that the bearer could return and collect their gold. Soon, people realized they could trade these receipts instead of the actual gold. After all, the note represented the value just as well, and it was lighter to carry. Here's where the trick was born. The goldsmiths noticed something. Almost nobody came to claim their gold at the same time. If they had 100 clients with deposits, maybe 1 or 2 would actually show up to withdraw on any given day. That meant most of the gold sat untouched. So the goldsmiths got clever. They began issuing more receipts than the gold they actually had. If they held 1,000 coins, they might issue 2,000 receipts. They could lend those extra receipts at interest, profiting from gold that didn't exist. As long as everyone didn't demand their coins at once, no one noticed. It was, essentially, money conjured from thin air. This wasn't just a neat side hustle. It was revolutionary. The moment people accepted paper claims as good as gold, money creation became unshackled from physical reality. Banks emerged from this practice, institutionalizing the trick. By the 17th century, governments themselves embraced it. The Bank of England was founded in 1694, not to serve the public, but to solve a problem. The crown was drowning in debt from endless wars. The bank lent money to the government, far more than it actually held in reserves, in exchange for interest payments. The debt was repaid not with treasure from new conquests, but with the taxes of ordinary Englishmen. Sound familiar? That's because it's the same mechanism governments use today, borrowing money that doesn't exist, then taxing future generations to pay for it. The United States followed the same path. Early American banks issued banknotes redeemable in gold, but they too quickly realized they could print more notes than they had gold to cover. Periodic bank runs exposed the illusion. Crowds of panicked depositors demanding their money, only to discover it wasn't really there. Entire banks collapsed overnight. And yet, instead of abolishing the system, governments doubled down. They created central banks to backstop the illusion. The message was clear. Even if the money doesn't exist, we'll make sure the public keeps believing it does. Now let's break this down in today's terms, because fractional banking is so abstract it can feel like smoke. Imagine you walk into a bank and deposit $100. You think that money is sitting safely in your account, waiting for you. In reality, the bank is only required to keep a tiny slice of it in reserve. In the past, that fraction might have been 10%, meaning the bank would keep 10 and lend out 90. Maybe someone borrows it to buy groceries, and the shopkeeper deposits that 90 into another bank. That bank keeps 9 and loans out 81. That money gets deposited again, loaned again, and so on. By the time the cycle finishes, your original $100 has multiplied into nearly $1,000 circulating in the economy. But here's the catch. Only the first 10 actually exists as cash. The rest is debt. Every new dollar in the system is born as someone's obligation to pay it back with interest. If that shocked you, I have some bad news. What I just told you is already an old story. In the United States today, reserve requirements are not 10%. They are 0. Since March 2020, the Federal Reserve has required banks to hold nothing, not a single dollar, against the deposits they take. That means the neat little multiplier doesn't actually control how banks lend anymore. So if banks don't need reserves, what stops them from lending infinity? The leash today isn't reserve requirements. It's capital and liquidity rules set under a global framework known as Basel. The Basel rules were created after a series of crises, especially after 2008, by a group of central bankers and regulators who meet in Basel, Switzerland, at the Bank for International Settlements, the so-called central bank of central banks. They aren't written by Congress or Parliament, but by unelected technocrats. Here's how it works. Banks must prove they have enough equity capital to absorb potential losses. The rules are complicated, but imagine this. If a bank wants to make a risky $100 loan, it may be required to hold $8 of its own money, shareholder equity, as a buffer. That's the real constraint. The more risky assets a bank takes on, the more capital it must hold. On top of that, banks must prove they have enough liquid assets to survive a short-term crisis. Cash, government bonds, things they can sell quickly. These rules are supposed to stop banks from flying too close to the sun. But notice what changed. Banks don't lend from deposits anymore. They create loans first, which in turn create deposits. When you get a mortgage, the bank doesn't pull cash from a vault. It types new money into your account. That new money exists because you agreed to pay it back. Then the bank checks after the fact whether it has enough capital to cover the risk. That's why in the modern system, more than 90% of the money in circulation is not central bank money, not cash or reserves, but bank money, created out of thin air the moment loans are issued. Think about that. When you see money in your checking account, it isn't the same kind of money the Federal Reserve prints. It's bank-created money, born as debt. That's why the money supply keeps expanding as long as banks find borrowers. And it's why every financial crisis is really a crisis of confidence. Because once borrowers can't pay, or once banks can't roll over debt, the whole system starts to unravel. This design creates three unavoidable consequences. First, inflation. Because banks keep multiplying the same dollars into more and more credit, the value of each dollar erodes. Prices rise, not only because of supply and demand, but because the currency itself is diluted. Second, perpetual debt. Since money enters existence as a loan, there is always more debt in the system than there is money to repay it. Interest ensures that the balance sheet never closes. Someone, somewhere, must always default, refinance, or borrow more. And third, concentration of power. Banks collect interest on money they never truly had. Governments tap the system to finance wars, welfare, and bailouts without raising taxes directly. And the wealthy, who own hard assets like real estate, stocks, and commodities, benefit as inflation pushes asset prices higher while ordinary workers see their wages lose purchasing power. When this machine hiccups, the illusion cracks. Look at the Great Depression. In 1929, banks had loaned wildly beyond their reserves, fueling a stock market bubble. When panic hit, depositors rushed to withdraw, but the money wasn't there. Banks collapsed by the thousands. The same happened in 2008. Banks had multiplied credit through mortgage-backed securities, creating a housing bubble built on the same principle, more promises than reality. When default spread, the system nearly imploded, and once again, governments and central banks stepped in, pumping trillions into the system to keep the illusion alive. They bailed out the trick, because without it, the modern economy cannot function. And this is where the global picture matters. In the US, reserves are gone. In Europe, the United Kingdom, Canada, and Australia, reserve requirements had already become symbolic or non-existent. They all rely on Basel rules now. Meanwhile, in emerging economies like China, India, and Brazil, reserve requirements still exist, often in double digits, and are actively used to control lending growth. But even there, Basel capital rules sit on top, shaping how much risk banks can officially take. No matter where you live, the leash on money creation isn't deposits in a vault. It's regulations written in Basel, Switzerland. Here's the uncomfortable truth. The system cannot afford for you to be debt-free. If every household paid off their loans tomorrow, the money supply would collapse. Banks would have nothing to lend. Economies would grind to a halt. The illusion depends on your participation, your willingness to borrow, spend, and believe the digits in your account represent something real. You are both the fuel and the collateral. That's why history matters here. The same mechanism that medieval goldsmiths used to conjure profits has been scaled up into the foundation of modern finance, and the same dangers remain. Bank runs in the 19th century, the Great Depression in the 20th century, the global financial crisis in the 21st century, all reminders that the system's stability rests not on gold or productivity, but on confidence. And confidence is the easiest thing to lose. So the next time you look at your bank balance, remember, most of it exists only on paper, born from a system of debt that was never designed with your freedom in mind. Understand the trick, and you can begin to protect yourself from it. Ignore it, and you remain just another player in a game where the house always wins.